Good afternoon and welcome to today's Premium Account ASX Top 50 Short Form Market Update for the 29th of May. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hind. I'm the current Managing Director of Investor Signals and Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. I have approximately 17 years of experience as a licensed securities and derivatives advisor. Up on screen is a graph of the US market, the Dow Jones. Now, as I've spoken about before, the index is trading at about 16.5 times forward earnings. We've just seen the March quarter earnings results come through with a growth rate of around 5%. From a forward outlook, the market's looking for the US earnings to continue on an annualized basis to expand around 8%, 8 to 10%. If that happens, it supports the index trading at the current valuation, especially where bond yields are. My base case for equities is that we largely move sideways. When we look at sort of the recent data out this week, we've essentially had great data out of the US around the durable goods orders. For April, we've seen US manufacturing rebound, and we've seen the Case-Shiller US House Price Index also providing sort of strong readings for the March period. Consumer confidence in the US continues to climb, so there's no reason to be bearish on equities, albeit that they've obviously had a terrific run. I think the base case is that equities likely move sideways, and then we get into this synchronized global growth picture later this year, and equity valuations move higher in that environment. One of the concerns that I just continue to reference at the moment is the 10-year treasuries in the US. In normal circumstances, if global economic growth was going to pick up, we'd expect to see the yield in the US at least move sideways, if not higher, but what we're getting is this inverse action where we're seeing yields actually move lower and equities move higher. So we keep an eye on this. I think this is an anomaly where ultimately global GDP will pick up as a result of central bank action, and over the next month or two I'd expect to see the yields bottom out somewhere around maybe this 2.3 to 2.5 and ultimately find support. So we'll keep an eye on that. I'll just shift this sort of down to this level here so we can keep an eye on that in the weeks ahead, where we'd look to see that yield find support there. Now, moving into the domestic market, so the XJO trading around 15 times earnings. We won't see the full effect of our 2014 earnings results until the companies report in August, but certainly the recent quarter updates that we've had suggest that maybe with the exception of the mining sector, we're looking at forward earnings growth somewhere around 5 to 7%. And like the US, I think that underpins current valuation, so we're not seeing any major risk to the downside, albeit when building a portfolio of top 50 stocks, there needs to be a real focus on the winners versus losers as to which names you have in the portfolio. Now, just to move through these quite quickly today, being a short form recording, AGK we like. It's had flat earnings over the last 12 months, but it should grow earnings about 5 to 8% into 2015. The stock's on just over a 4% dividend yield, trading 14 times earnings. We own it, we've sold the covered calls, we're collecting the dividend, the call premium, and that's driving 10% cash flow out of AGK. Asiano's on the radar. We've been watching this closely. The story here is the company's increasing dividend yield, but we haven't seen a lot of proof of earnings growth. They're focusing on cost cutting. On a forward outlook, we'd expect the company to deliver, or the market would expect the company to deliver around 10%. I'm just not so sure the company's going to do that. I think there's better value elsewhere in the market. Amcor is one of those examples. I've marked this as a high conviction, as this was a stock that we've been strong buyers of at $10. Our aim was to ride it up to $11 and then sell the $11.25 calls. We're getting pretty close to that level at the moment. The stock's trading at around 15 times earnings on a 4.5% dividend yield. I think it's a positive in the respect that the company will grow earnings 8 to 10%, but it also gives us exposure to US dollars. So if we were to see a recovery in the US, the Aussie dollar pull back, Amcor is going to be a beneficiary of a lower Aussie dollar environment. So it's in some ways that theme acts as a little bit of a hedge in a down market. But Amcor's performing strong and doing as expected, so we want to continue to add that to portfolios. AMP not doing anything there. I've got this on about 17, 18 times earnings on a 4.5% dividend yield, but a little bit patchy from an earnings trend perspective. So we keep it on the radar, but it's not part of portfolios at the moment. ANZ, were buyers of the banks in general, so the three that went ex-dividend, ANZ, Westpac and NAB, we've all picked up those in the recent weeks with a view that they'll rally around 5% and then we'll look to sell the covered calls. So that strategy's playing out. In the case of ANZ, I think if we can sell the calls up at around $35 into the back half of this year, I think we're probably likely to see the stock bounce up against that next level of resistance. Roughly around 3 to 5% underlying earnings growth for the Australian banks, trading on a 5% dividend yield. ASX, another one of these high conviction purchases. We're strong buyers of it down here at $35. As it rallies back up here at around $38, you want to be selling covered calls. Combine that with a 5% dividend yield, you're getting about 10% cash flow, opportunity for some good capital growth. The downside risks are protected. I think ASX will continue to be bid up on any pullback as a result of the potential of corporate action taking place over the next year or two. So we want to keep ASX in portfolios. AZJ, the pullback that it's had after the corporate announcement with the potential capital exposure they're going to have into expanding their haulage into the Pilbara. At this level, I think it's a buy, so we're buying it here at around $4.90. We're waiting for a rally back up to $5.10, $5.20, and then we look to sell the covered calls. From a valuation standpoint, the stock's trading on a reasonably high PE, up around 19 times earnings, and the market's looking for about 20% earnings growth. Even if AZJ delivers somewhere around 15% earnings growth, which I think is probably where it sits, it supports a valuation around $5, so continue to like that. BHP, so this is the only resource stock we like, looking for it to just push a little bit higher, and then we'll get calls away up at around the $40 level into the mid part of essentially around September, October of this year. The prospect of the company buying back shares, the upcoming dividend, exposure to the petroleum and oil and gas sector in the US, I think continues to make BHP attractive relative to the other resource names. From a valuation standpoint, the stock's trading on about 3.5% dividend yield and about 13 times earnings. Brambles is expensive up here. We own it at lower levels. We've sold the covered calls. The stock's trading about 19 times earnings on a 3% dividend yield. So I think fair value for Brambles is actually back at around $9.30, but happy to continue owning it and selling the covered calls. CBA coming up to the next dividend. This is getting pretty strong from a price standpoint, pushing up to around 17 times earnings on a 4.5% dividend yield. So arguably the other banks are better value, but it is the next in line to pay a dividend, CBA. Coca-Cola, so on this recent rally here, we took the opportunity to sell some covered calls into December. I don't see Coca-Cola recovering short-term much above $10. At that point, it puts the stock, assuming that it has flat earnings and the earnings downgrades that the company's had has come to an end, puts the stock at about 12 times earnings on about a 5.5% dividend yield if it was to be trading up around $10, and I think that sort of caps the story there for Coca-Cola. Computer shares expensive up at these levels, have it trading on a PE up around 20 times earnings on a 2.5% dividend yield, so I think it runs into resistance, but we certainly like the business. It's growing earnings 5 to 8%. CSL, continue to like this name, trading expensive at 22 times earnings on a 1.5% dividend yield, but the company's got about another $300 million worth of shares to buy back over the next few months, and I think it runs sideways in that environment. So owning it at lower levels, selling the covered calls, continues to make sense for portfolios with CSL. Crown, I'd spoken in the previous recording that just purely from a trading perspective, it was getting down a value here at $15.50, up at around $17. Time to take profit on that trade and really wait for a pullback again. GPT within the property play, we like this name. We've really owned it at lower levels. We've started to lock in some profit up here. I think as these property plays compress down to low yields, they're starting to run into some short-term resistance. GPT should grow earnings around 7% going forward. Iluka, just some interesting commentary here out of the CEO that he seems to make the comment that the worst is behind Iluka for mineral sands, and they're expecting to see stronger demand in the years ahead, so we just continue to watch Iluka. IPL reported its earnings, about 7-8% underlying earnings growth, slightly beat market expectation. From a yield point of view, I've got IPL trading at around 4% dividend yield and about 13 times earnings. Looking for it to find support here. I think over the next 12 months IPL can trade higher. James Hardie's added to the index now, and we include this with a high conviction, and we'll start to look at the numbers on this, but trading roughly around a 4% dividend yield with strong underlying earnings growth, so we continue to sort of watch that closely as an addition to portfolios. Lendlease, the stock's expensive, but we certainly like this name. We own it at lower levels. We've capped the upside out from really here. But from a valuation standpoint, the stock's now trading somewhere in the order of around 15.5 times earnings on a 3% dividend yield. I think over the forward next 12 to 24 months, the company will grow earnings at 10%, so I'll certainly start to justify these prices, but I expect to see some consolidation and sideways movement there in Lendlease. Mirvac, we've seen increasing acquisitions of Mirvac of land parcels to continue the build out within their residential portfolio. I think the underlying business is growing earnings about 5 to 7%. We've got the stock on about a 5% dividend yield, about 15 times earnings. So it's an interesting one, but our preference has been Westfield Retail, Lendlease and Stocklands within the property allocations of the portfolio. So Macquarie we like, albeit continue to highlight that it's trading about 20 times earnings on a 4% dividend yield, and the market's already pricing in 20% earnings growth over the next 12 months. So in some ways the argument is that it's priced to perfection right at the moment. NAB I like in conjunction with ANZ and Westpac. Down at these levels, NAB's trading at about 6% dividend, or 5.5% dividend yield, trading at about 13 times earnings, and in line with the other banks looking for around 3 to 5% underlying earnings growth going forward. Origin, we've got option expiry today, so we own Origin at lower levels. In some instances, we've capped that out around $15. When you combine what we collected in the dividends and the call premium, we've been getting roughly 10% annualised cash flow out of Origin, plus the capital growth. For clients that are still holding Origin with longer dated calls, we've capped it out around $16. I suspect that the stock will run into some resistance. There's obviously a lot of optimism around the oil and gas sector at the moment, as we've seen Exxon ship their first gas from Papua New Guinea, and as the de-risking of the capital expenditure that Origin has had gets closer to the finish line. But in saying that, you need to put in the context from a valuation standpoint where things are sitting, and Origin's trading at about 21 times earnings on a 3% dividend yield. Over the next 12 months, we are looking for earnings to tick up in excess of 10%. So certainly, by this time next year, I think Origin could be trading $17.50. But right at the moment, I wouldn't be surprised to see it consolidate and move sideways from these levels. Oil Search, as I just mentioned, beneficiary of the exposure into the partnership in Papua New Guinea with Exxon, and seeing the first gas shipped ahead of schedule there. So we'll expect to see a big uptick in Oil Search's earnings over the next, starting now, but certainly seeing that flow through to better dividend returns to shareholders over the next 12 months. QBE, we've seen analysts upgrade the earnings outlook for QBE from a lot of underperform ratings to an equal weighting. From our perspective, there's still better areas of the market. It comes onto the radar, and we watch it with interest, but we're not allocating funds there at the moment. Ramsay Health Care, I think high conviction here at $45. The stock looks interesting, and expect it to sort of hold those levels. The capitulation in the iron ore play, I think, sort of probably getting close to running its course. We're still not shifting money outside of sort of our single commodity exposure, really, single resource stock exposure being BHP. We've had a good run on Woodside Petroleum. We've taken profit. But in Rio's case, from a valuation standpoint, it's trading about 10 times earnings on a 3% dividend yield. But with iron ore trading back below 100, I think we're probably at best looking at some consolidation and turning point here. But I think we're close to sort of a capitulation level in some of these sort of pure iron ore plays. Stockland coming into its June dividend, paying 12 cents at the end of next month. As expected, the stock's pushing higher into that dividend. As it gets a little bit closer, we'll look to cap that out through the sale of a covered call. We'll collect the June dividend, we'll collect the call premium and drive that 10% cash flow. Sonic Healthcare, I like this name coming into the August dividend. I think from a valuation standpoint, it's really sort of full value, so it's a matter of owning the stock and selling a tight covered call. That pushes the yield up from around 4% to around 10%, but looking for it to hold up coming into that August dividend. Santos, so we own this at lower levels. This has certainly been one of our high conviction buying opportunities. We've sold the covered calls at $14.50 and collected around 30-40 cents for those, so we have effective exit price up here at $15 over Santos. I'd expect the stock to run into some resistance at or near that point. The stock's trading at about 20 times earnings on a 2% dividend yield, but a little like Oil Search and Origin, we expect to see a big uptick in earnings over the next 12 to 24 months, and that'll flow through to higher dividend returns for shareholders. So I think whilst these names might run into a little bit of resistance over the next month or two, any pullback will be an opportunity to reacquire shares with a sort of a longer 12-month outlook, as I would expect these oil and gas names to be strong beneficiaries of above average earnings growth over the next sort of 2 to 5 years. Transurban pays its dividend at the end of December, roughly around 19 cents, so the stock is expected to remain strong into the dividend. We're seeing the last of their capital raising there for the rights issue to existing shareholders at $6.75, and I think the stock probably could trade up to $7.50 coming into the div, but post the div I'd expect it to settle back down at around $7.30, $7.25. That puts it back on a 4% dividend yield. Right at the moment, the stock's almost sort of compressing below a 4% yield, and I just don't think it sustains that. So post the dividend, I think what you're seeing is a lot of money rotate into names that are coming up to paying their dividends, and then post that you'll see a little bit of a sell-off as the market readjusts. I think the right price for Transurban's trading back at about a 4.5% yield, and therefore the price should settle back around $7.25 after the dividend. Same with Telstra. We're seeing a strong push higher coming into the August dividends. Telstra's trading at about 16 times earnings on a 5.5% yield. Underlying earnings growth around 3 to 5% at around $5.50 into the div. I think it runs into resistance. Back the dividend back out somewhere around sort of $5.30. The stock should settle post the August dividend. Toll, we own this at lower levels here. We didn't see much in the way of earnings growth over the last 12 months out of Toll. The market's looking for about 5% earnings growth going forward. Our strategy's been to own it here at lower levels, up at around sort of a rally up to around $5.75. I think take the opportunity to sell the calls at $6. I don't see the future earnings growth over the next 12 months supporting a push above $6 for Toll. Westpac, we like this name as the strategy on the other banks were buyers of it off this point, letting it rally 5% and then sell the covered calls. We've just recently collected the dividends on the banking stocks. WDC, we've got the shareholder vote today where they're looking at spinning off WRT, and we'll know by tomorrow whether that vote goes through or not. Our strategy broadly, though, is to keep exposure to WDC and take profit on WRT. Wesfarmers continue to like Wes, so we own it at lower levels. We're selling the covered call. To put some numbers on this again, just to refresh your memory, the stock's trading at about 20 times earnings on a 4.5% dividend yield, so it's expensive, but underlying growth maybe somewhere around 8% should underpin any sell-off, and I think the next stop for Wesfarmers is probably somewhere up at around $44 to $45, so we continue to look to add exposure to it, but mindful of the fact that it's trading on a high multiple. Woolworths, so part of option expiry today, we're going to be delivering some Woolworths. When you factor in what we've collected for the calls, we're effectively exiting the stock up here at around $36 after owning it at lower levels. One of the opportunities that are available to us is to actually repurchase the stock tomorrow, go out into the late December and sell the covered call up at around $38.60, and we're collecting an extra 90 cents for that, so that'll complement the upcoming sort of 70-cent dividend in August. From a valuation standpoint, Woolworths is very expensive from a PE standpoint, trading at about 20 times earnings, 19.5 times earnings on a 3.5% dividend yield, with forward earnings growth about 5.5%. So I would expect that this is one of these plays where we're seeing a lot of capital rotate into names ahead of the August dividend, but ultimately once we get through the August dividend, I expect to see sideways consolidation for Woolworths. And WRT, as I spoke about, we'll revisit that in next week's recording post the shareholder vote. Thank you for listening in to today's recording. If you'd like to know more about the Investor Signals premium account service, please contact me on the details on screen.